Good afternoon. This is Sean Golding with Golding & Golding, here to discuss the basics of the FBAR, otherwise known as FinCEN Form 114 and IRS Form 8938. Quick background. Form 8938 is the result of FATCA, the Foreign Account Tax Compliance Act. For taxpayers, they began having to report this on their 2011 tax return in 2012. The FBAR has been around for 50 years. It is a FinCEN form, Financial Crime Enforcement Network, as we like to say, try to disassociate the term criminal from the FBAR. They typically have nothing to do with each other. It was only in 2003 that the Internal Revenue Service began enforcing the FBAR, but it has been around for several years. Let's start with Form 8938. Form 8938 is one of those international tax forms that's only required when your tax return is due to be filed. So if you don't have a tax return filing requirement, then you don't have to file the Form 8938 separate and distinct from your tax return. That's different than the FBAR, which does have to be filed. We'll get into that in a minute. So Form 8938 is used to report specified foreign financial assets. And pretty much any foreign asset you could think of is going to be reported on the 8938. Most accounts, unless accepted or excluded, foreign assets, foreign stock, life insurance, foreign investment funds, things like that. And the Form 8938, as I mentioned, it's due to be filed at the time your tax return is filed. So if you're on extension for your tax return, you go on extension for the 8938 as well. When completing the form, it's a bit more complicated than the FBAR because, first of all, there's different thresholds depending on who is reporting the form. For example, if someone is single and residing in the U.S., the threshold is $50,000 on the last day of the year, or more than $75,000 on any other day of the year if they're under the $50,000 threshold on December 31st. Conversely, if it's a married filing joint couple overseas, those numbers jump up to $400,000 on the last day of the year, or $600,000 on any other day of the year. Unlike the FBAR, Form 8938 requires the taxpayer to identify the income being generated from the specified foreign financial assets and the category and the amount. So is it a dividend, royalty, capital gain, etc., etc. So the form takes a little more time to complete than the FBAR. There's also more specifics on there designed to try to catch the taxpayer. It'll ask if it was the first year. What it'll ask, was the account opened in this year? Was it closed in this year? Is there any tax resulting from income generated from the asset, and is it a married filing joint account? So the IRS can use this to kind of work backwards and see in prior years if you had done this properly. On the other end of the spectrum is the FBAR, foreign bank account reporting, foreign bank and financial account reporting, aka FinCEN Form 114. It's different. It's filed electronically only, and it has to be filed by any U.S. person who meets the requirement or meets the threshold of being a U.S. person, even if a tax return is not filed. So let's say someone comes to us and they went through that little computer program on the IRS and spits out, oh, you don't have to file a tax return. But let's say that individual had, $500,000 to $1 million in foreign accounts that just didn't generate sufficient income for them to file a tax return. Well, they still have to file the FBAR. The FBAR is due at the same time the tax return is due. That changed the last few years ago. A person doesn't have to file a separate extension for the FBAR. It goes on automatic extension when someone files an extension to complete their tax return. The big thing with the FBAR is really filing it timely. Unlike the 8938, the information on the form is much more limited. It basically just wants the taxpayer's background information, social security address, which most taxpayers don't want to provide, and a little bit of the account information, the balance, max balance, if you can get it. That will vary based on country, type of account, NAV value versus straight balance, whether it's a passbook account or the type of bank account where they will give you monthly, weekly, yearly statements. Not all foreign banks do. The address, things like that. You don't have to report the income or anything related like that. It's a Title 31 form, not a Title 26 form. It's basically part of the anti-money laundering campaign back in the day. And as I said, it's filed electronically, and the key component is to file it timely. When you hear these two different forms, the main concern for the taxpayer, of course, is the penalties. Now, when it comes to the FBAR, the penalties can be brutal. Um, if it's non-willful, there's four categories. It's a warning letter in lieu of penalty, yay, right? One $10,000 penalty for the whole shebang, one $10,000 penalty per year, one $10,000 penalty per account or per occurrence per year. Uh, the that one's rare. The most latter one is rare. It's a rare day that someone comes in, contacts us and says, "Hey, I didn't file my FBARs for a few years. I have 17 accounts. I got hit with a $10,000 penalty for those 17 accounts for 3 to 6 years." It doesn't really happen that way. Willful penalties are tough. A willful FBAR penalty is a 50% penalty on the maximum value aggregate total of unreported accounts per year, up to 100,000, up to 100% max. So it used to be you could get hit with a 50% penalty per year for 6 years, 300% value of your account. Fair, right? So then the IRS went back and they limited it to just all the money you've ever had in the account during the compliance period, or $100,000, whatever's higher. So generally that would mean that $100,000 is the floor. People are trying to fight it based on an old regulation, which makes it sound like 100,000 is the actual cap. Most courts have disagreed and have taken the IRS's favor on that. The Form 8938 penalty is a little different. It's generally a $10,000 penalty for not filing it, and then if it hasn't been filed in 90 days, there's another $10,000 penalty, and continuing failure to file up to $50,000 for the continuing failure to file penalty, in addition to the $10,000 initial penalty. How do you avoid all these horrible penalties? You do one of the amnesty programs. There's various amnesty programs available for FBAR, FATCA, and basically any information or reporting you might not have done. International information returns typically include things like 3520A for foreign trusts, 5471 for foreign corporations, 8865 for foreign partnerships. I could go on forever. But there's various different amnesty programs. If someone is willful or they can't certify under penalty of perjury that they're non-willful, that willful versus non-willful is a whole nother discussion, a whole separate presentation. They go the traditional voluntary disclosure route. Yes, the IRS terminated OBDP at the tail end of 2018, but then they expanded traditional voluntary disclosure in early 2019, expanding how to submit when you have unreported offshore accounts, assets, investments, income, trusts, etc. Alternative to the traditional voluntary disclosure or the Streamlined Program, they're very popular. The main name is the Streamlined Filing Compliance Procedures. It's broken down further into the Streamlined Domestic Offshore Procedures, Streamlined Foreign Offshore Procedures. Foreign is for foreign residents, domestic is for U.S. residents, or non-foreign residents, I should say. Domestic carries a 5% penalty. Streamlined Foreign, total penalty waiver. There's alternatives to the Streamlined Program depending on lack of unreported income. There's a delinquent international information return submission procedures. There's the delinquent FBAR submission procedures, and of course, there's always reasonable cause. We have lots of other free information on our website. The main website is goldinglawyers.com. Sister website is irsstreamlineprocedures.com. My name is Sean Golding from Golding & Golding. Enjoy the rest of your day.